Chapter 14, we're going to talk about the sales and collection cycle and auditing that cycle. So there's different types of transactions that are included in sales. So we've got accounts receivable in sales. Obviously, when the product ships out and we bill our customers, we set up a receivable. So that process can be a separate group of transactions. Then we have the cash receipts. So the customers then receive the bills and then they pay the company. And then how is that process handled? Then a separate process can be sales returns. So if the company sets up a sales returns and allowance account, when those products get returned to them for whatever reason, and then they credit the accounts receivable transaction, that could be a whole process that of course needs to be audited because sales returns can indicate some different things to the audit, such as like fictitious sales or stuffing, like sending out all your product to the customer and then allowing returns to come back in the next year, or to kind of push sales from one period to the other period. So the auditors always look at that process. Uncollectible accounts is another thing the auditors are going to look at to see what have we estimated our bad debt expense to be? What have we set up in our allowance for uncollectible accounts? How do we write them off? When do we write them off? What are the processes for that? And then of course that's kind of goes hand in hand with that next one, the actual bad debt, to say how do we know at what point, how do we collect on those accounts receivables, and then at what point do we say, okay, let's write it off because we're not going to collect. So the different documents that the auditors are going to want to test through and have an understanding of is the customer orders. So how does that process go? Does the customer log in and create an order? Do they send in a purchase order? Do they call? Then is there a sales order then that's issued, which would be an internal document outlining what goods were ordered and indicating that it's been approved to go out and that customer has been approved. They have the proper credit with the company and the shipment gets authorized. So that sales order might be how how to process that through the system to get it so that it gets to that next step. So say it's a brand new customer and we've got that sales order, then we're going to need to go through the whole credit approval process. So again, that could be the next step. If it's a new customer, if it's an existing customer, it's going to go from sales order right down to the shipping document or the bill of lading. So then that's going to list out all the parts that are pulled from inventory and that are being shipped to fulfill this order. And then once the goods are shipped, then we create an actual sales invoice that goes out to the customer, which would include the parts that they purchased, the price, the terms, the amount due, the due date, all of that stuff. So all of these documents would go kind of sequentially in order, and the auditor would want to trace a transaction through from that customer order all the way down to that sales invoice. Then once it gets posted into our IT system, then that is what these next transactions. So then you could trace it into the sales transaction file where it's actually entered into whatever system they're using. Then you could trace that individual sale into the sales journal, which would have all of the sales for the period. Then you could trace that invoice into the accounts receivable trial balance for that one customer to say, okay, yeah, there it is. It's outstanding at the end of the year. And then maybe if monthly statements are sent out. Not all companies do monthly statements, so that's not required. But sometimes they do, especially if there's multiple invoices by one customer that would show these are your invoices outstanding and the amounts and the due dates. So other processes relating to the sales function, we have again, collecting those cash receipts. So when the customer pays us, what comes back with the cash receipt? So maybe they've got, some sort of it could just even be the top of the check. It could be some sort of a, piece of paper that gets included in there. but something that probably is going to show what they paid, like invoice numbers, that type of thing. Then those cash receipts come in, and then maybe like the mailroom personnel provides a listing of all the cash receipts that came in that day, and then it gets taken to the bank for deposit. So that you could look from the remittance advice of the check that came in, tie that check into the pre-listing of the cash receipts, and then eventually that would actually go into the cash account. Sales returns, are there credit memos issued to the customer that shows this is what you've returned and this is the amount that we've applied to your accounts receivable balance? Again, that would be the proper flow of paper trail. And then our uncollectible accounts, normally bad debt is estimated at the end of the period to say, okay, we estimate like 3% of our accounts receivable could be uncollectible. So we're going to record that to bad debt expense and then set up an allowance for uncollectible accounts. Then as we go through the year, we look at specific accounts to say, okay, I don't think this customer is going to pay us. We heard that this customer declared bankruptcy, kind of whatever the case may be. And then we would get that approved and that account would be written off. So the accounts receivable would be written off to the allowance for doubtful accounts. So the audit tests of that sales cycle. So when we're understanding the internal controls and assessing the control risk of the sales cycle, we want to first look at those key control activities. So is there adequate separation of duties? So again, thinking back, to those internal control procedures, that would say that a person who actually handles the cash is not the same person who does the recording of the cash. So like I said, the mailroom lady possibly gets all the cash, all the checks that come in. She prepares that cash listing and takes it to the bank. But then there's somebody in accounting who actually records the receipt of all those checks that come in. So again, the person handling it doesn't record it. Looking at, is there proper authorization of credit before making a shipment? So has that customer been approved? Have we done a credit check of them, and do we know, are they up to their limits on the credit that we have offered them prior to making a shipment to them? Again, that would help in monitoring bad debts and things like that. If you have a customer who hasn't been paying, maybe then you put a hold on their account so you would not make any more shipments until they pay. Is there adequate documentation? So we should have pre-numbered shipping documentations, pre-numbered shipping documents that then trace into invoices. We may possibly then trace those into customer orders. So again, is there a nice paper trail, and is everything pre-numbered and any numbers that are missing, accounted for as either being void or whatever? Are monthly statements mailed out to the customers? Again, that's not a requirement. Not all companies do that, but if they do that, we would want to understand that process and maybe test some of those. And then is there an internal verification where an independent person reconciles the accounts receivable? Again, that would help limit the ability of people to commit fraud. Because again, if you could take a cash receipt and steal it and then cover your tracks by giving them a credit memo or putting it into a different accounts receivable account, or put it into a miscellaneous customer account, or just something that kind of covers the fraud. Again, so if there was someone independent who's reconciling that would help limit the availability of a person to commit fraud. So then we get into tests of those controls. So kind of what are some of the things that the auditors are looking for? So they're looking for a fictitious sale, because normally if we're going to commit like accounting fraud, so we're not stealing, but we're wanting to kind of, make the numbers look more attractive than they really are, we would want to have more sales. So if we would record fictitious sales, that would bump our sales up, make our financial statements look better, our net income look better. So a way that the auditors can test is that they can go from the sales journal back to the shipping document. So you don't start with the shipping document, but start where it's in the actual ledger, making up the total sales, and then make sure those all trace back to valid shipping documents. Is there unrecorded sales? So that shipments have occurred, but we have not recorded that sale. So again, that's not necessarily fraud. Maybe that's just not the best internal control procedures, that we might ship something out without actually sending an invoice to the customer and not getting paid. So it's not good operating procedure. But that's the completeness part of the audit objective. So then in that case, we're going to go from the shipping document to the sales journal to make sure that everything that got shipped had an invoice created and that invoice posted into the sales. Look for duplicate sales, just review, download all the sales journal, look for all the numbered invoices to make sure that there's no duplicates in there, like there could be an A and a B or just something that could trigger them to look more closely into those invoices. Shipment to non-existing customers. So again, it's kind of a little bit of that same fictitious sale to say if we're going to ship product so that we can record the sale, but not to a customer that's on our file. So trace that customer information from the invoice to the master file to make sure that they're approved customers and they have credit and that they're valid, and we're not just kind of, we have a friend that owns a company and we're going to ship them product just to get our sales up, and then they can turn around and send it back to us. Accuracy to determine that all the sales are recorded correctly, that we're using the correct unit prices, that all of our computer processes where you take your quantity times your price, all those mathematically work out correctly, and that everything is properly classified and recorded in the proper period. So some specific issues in the selling function would be sales returns and allowances. Again, because that's a way that you can kind of like stuff sales into one period and then allow them to return the next. So you're bumping up your sales at the end of December, giving them an open window to return everything in January. So auditors do look at sales returns and allowances for materiality and for occurrence. And then it also could be, people could use sales returns and allowances to cover their tracks of stealing cash. So again, a customer pays, you divert the cash into your own account, and then you issue them a credit memo so that the customer never sees it on their statement. They believe everything is fine, but really the person who is handling that accounts receivable stole the cash. Cash receipts, obviously, again, because cash is something that can be stolen. So the auditor needs to look at those internal controls to make sure everything's working as it should. So that pre-listing of cash receipts by, again, an independent person is a good control. Then that gets deposited, and then the record of it is, the recording of it into the general ledger is by, somebody else, a different person. There's a segregation of duties. And then it's nice to have that independent verification to then have like an accounting manager or an assistant controller or an internal auditor, somebody else actually reconcile the cash account. So then they can take it, all the way from that pre-listing of cash receipts into the cash account, into the actual bank account. So then there can be lapping where, again, this would be fraud for somebody who works in the accounts receivable department, where they steal money and then they use the next cash receipt to cover that cash shortage. So they're constantly kind of covering their fraud with the next check. But again, you'd have to keep that going for it to work, or eventually the customer is going to catch on that their cash that they paid to the company wasn't properly applied. Uncollectible accounts is, again, another area where you could cover fraud, write things off as uncollectible when really they did pay and somebody stole the money. So GAAP requires us to estimate those bad debts and to charge them in the period that the sale was generated. So again, it's always an estimate. So then the auditors are going to come in and kind of look through that whole process and definitely look at everything that was written off to see was it properly approved. Do they show evidence that it was uncollectible? They tried to collect it, couldn't do it. They maybe did the company declare bankruptcy, and you could prove that. And the whole point is to get our accounts receivable to their net realizable value that's on the balance sheet. So that would be your accounts receivable less your allowance for uncollectible accounts is going to give you that realizable value of accounts receivable. So that is kind of auditing the sales and the accounts receivable process, just as a more of a general overview of that whole process.